Given, though, the regulatory crackdown in China right now, there are a lot of people who say, you know what, you shouldn't be investing in China. You have a different view.
Yeah. I just know China very well. And I come as a perspective. I've been going there since 1984. I know leaders and I know how they're thinking and I know the moves that they're making in a detailed way. And I'm just trying to share what that perspective is, because I think a lot of people make stereotypical moves. And I think you have to really understand. First thing you have to understand, because it has been a remarkably successful place. Since I started going there in 1984, per capita has increased by 26 times and so on. So to not understand it or to approach it with a great bias is a great disservice. Okay.
I think the first thing is almost everybody's underweighted China. So if you look by any of the benchmarks relative to world capitalization, and it's also a normal thing because over periods of time, the reserve currency, everybody wants to save in it, the world capital markets, you invest there. So it's underweighted. The first move is to get exposure to China, to get exposure in a diversified portfolio. That means to achieve the right kind of balance of assets in China. Our approach is, we call it an all-weather approach. It's a certain balance in which you achieve balance without lowering the expected return. From that, you want to make the tactical moves. And of course, those change depending on the relative pricing of assets, classes, and so on. But first, to get the exposure, I believe, to those markets and the currency too.
China is becoming an effective place to invest money. Something like 40%, over 40% of the IPOs are going to be Chinese stocks on Chinese markets and so on. And capital flows work that way. And history has shown us that when there's an empire, an emerging empire, they build the financial markets, they build the financial system. So Amsterdam was the world's financial center during the empire when there was the Dutch guilder. London was the financial center of the British Empire. US, we had New York. And so we're seeing that merge. All of that changes the supply and the demand that is threatening to the reserve currency status. Just imagine it's a state, okay? The state of Connecticut, the state of Illinois, and so on. And you can't print the money. That means you either have to raise taxes or cut spending. And history has shown in these empires that that causes great conflicts, because raising taxes and or cutting spending has been all through these empires. And I've studied, I don't know how many over a long period of time, the number one reason that you have civil wars. So yes, it's easy to say we have to earn more than we spend and so on. But in this environment, in this highly fragmented environment, how are we going to get there?